Hi everyone, I'm Hema here. This series of videos I'm going to produce for consolidations. You will be benefited by this, and if you like my videos, please subscribe and comment on the comment box. Now we will see consolidations. Consolidations are tested normally in every financial reporting and accounting, advanced stage or the medium stage examination level. So this series of consolidations will be useful for you to learn and practice. Now we will see what is consolidation. Consolidations means combining things as a whole, combining things together. So this happens in accounting as well. How it happens? When a company, we'll call it P company, invest in S company and acquire the control. What is control? I'll be explaining in a short while. It acquires the control. Then it can control the activities of the companies for the benefit of the investor. So this company, we'll call S Limited, will become a subsidiary of P Limited. The relationship changes when the control is acquired. So we will see how these things happens in practice, and when subsidiary and parent relationship exist, IFRS 10 consolidation statements says that you have to consolidate the set of accounts. That means it treated as one entity. The P&S, we call it as a group, and this group will be treated as a single entity. And you have to prepare the accounts as a single entity. You may ask where there will be only one subsidiary and one holding company or parent company. No, in practice, there can be several subsidiaries owning by a parent, and the parent itself can be a subsidiary of another parent. All these structures can exist. And you may ask, what is the control? So the control in short form, usually what they say is over 50% of the voting right of the ordinary shares. If you purchase another company's ordinary shares more than 50%, then it is said to be a control, the voting rights. Why the voting rights? That means that you can vote against the decisions that has been taken. There can be 100% control. There can be 80% control. There can be 50% control or 51% control. Then it becomes a subsidiary, and control is important. Control means you will be able to appoint or remove the board of directors. You have the power. And also you will be able to decide on the relevant activities of the company of S Limited. So the power is there to make decisions and make the company function in the way that P Limited wants. So these are the substance of consolidation. The consolidations, we don't take the legal form because P Limited is also a legal entity. S Limited also a legal entity. Those are two legal entities. They will be preparing separate financial statements legally. But for consolidation, it has to be treated as one single entity. And one set of books we have to prepare. If there is a parent-subsidiary relationship exists. So we'll see how we are going to prepare this and what are the implications and what are the adjustments, what are the points that we have to consider to achieve this. So in detail, I'm going to explain one by one what are the things that we have to do to achieve a single unit financial statement for a group. That's what we are going to see from now onwards. So in this video, I will explain a little bit of that. And my coming videos, we will be explaining and we will be explaining yes, now you can see the screen. Sorry, there was a time lag between the screen. Now we'll see the screens. The meaning of consolidation is combining things to bring in as a whole. I explained to you. In accounting, this happens when entity acquire control of another entity, and usually it is more than 50%. So if you see this screen, there is P Limited and S Limited. P Limited has bought 100% of S Limited, then there is a control. And there is no outsiders involved in S Limited. 100% is P Limited. Here, P Limited has bought 80%. That means 20% outsiders are there. Still, P Limited is having the control. That means that balance 20%, we call them as minority interest or non-controlling interest. IFRS 10 calls it as non-controlling interest. So the 20% is outsiders' share in this company. Still, the parent controls that. Again, P Limited is holding 51, the minimum. That means still the control is there and the 49% is owned by the non-controlling interest. So non-controlling interest also an important component in the consolidations. When the holding between 20 and 50, okay, this is more than 50. 50 and 100 means consolidations, control, and a relationship of parent and subsidiary. What happens if the relationship is less than 50%? If it is between 20 and 50, there will be some significant influence that you can make as a shareholder in making the decision. But still there is no control. You can't control and you can't make decisions. So we call this relationship as associate, parents and associate. If the holding is less than 20%, you are just an investor. You have to just wait and see what is happening in S Limited. You have no control. So you have to decide whether to hold the shares or dispose the shares. You become the minority interest. That means non-controlling interest. So this control exists when more than 50% of the shares were bought. But in some cases, it can be in legal form 45%. P Limited owns 45%. And strictly speaking, legally, it is an associate. But in substance, what is happening is, the balance 55% shareholders are all over the world. They are scattered and they have no influence in the decision making. P Limited is making all the decisions. Then what happens? In substance, it becomes a subsidiary because P Limited is having the control of S Limited, the balance 55% are not in control of the company. In another example, we can say 45% P Limited is owning. Another 35% a bank is owning, we will say. The balance is non-controlling interest. What will happen? 45% plus 35% becomes 80%. So the bank agrees to go along with P Limited decision. We say bank is saying, I will support you on all taking all the decisions. Then what happened? P Limited is really controlling the business because whatever the decisions making, P Limited is making, bank 35% will go along with that. So that means totally he is having 80% control. This is sometimes, this control is very difficult and a complex affair to fathom. So in your examinations of a financial reporting paper, at an intermediate level paper, you will be given over 51% and prepare the consolidated balance sheet and P&L. Consolidated statement of financial position and consolidated statement of profit or loss. But in the advanced level examinations, if you are doing a strategic level examination, then you will have to decide whether there is a control exist or no. You will be asked to do so. Then, now we will see what is the control. Control is IFRS 10 defines control as a 3 element. One is power, other one is exposure to variable returns. Variable returns meaning dividends. You can control the dividend policy. If there are profits or losses making, you can control that. You can make a company profitable, or due to something it may lose. It also can happen. So you control our exposure to the variable return. Then, and the investor's ability, the investor is the P Limited in our example, use power to affect its amount of variable return. It can take decisions. It is capable of taking decision to control the relevant activities, which will in turn will produce profit or loss. That power is there. So what is the relevant activities? So the ability to use the power over the investee to affect the amount of relevant activities. What is the relevant activities? Normally, generally, it's selling and purchases of goods and services, managing financial assets, and determining the financing, funding, or obtaining funds. That means issuing new shares or debentures, all that. So if you are a holder and 45%, and if you have voting rights over 51%, your voting rights can be even potential voting right. That means if you are owning, for example, preference shares, convertible preference shares, convertible debentures, at one time, this all will be converted into ordinary shares, which is having the voting rights, and you will become a controlling authority of more than 51%. So in IFRS 10, it gives some rights other than the voting rights. That means if you have these rights to appoint, reassign, or remove any management personnel at the top management, directors, then you have the directors who is directing the relevant activities, and you are having the ability or the power to change them. then you are in control and you are having power. Or you might appoint and remove entity that direct relevant activities. There will be an entity that who will be having shareholders. That entity is directing the relevant activities, and you should have the power. You have the power to remove or appoint that entity. So in that case, you will have the power. Rights to direct the investing. And what is the veto power? There is a thing called veto power. Veto power means you have the power through another person. In my earlier examples, bank. Bank is going along with your decisions. That is a veto power. So the veto power also can be a power for you to exercise control. And when we are doing when we are having a control, it will become a parent-subsidiary relationship. And the parent-subsidiary relationship means that we have to treat the group, that is called a group, parents and subsidiaries called a group, and the group should have one single entity format. Actually, we are treating this as one single entity, and we had to prepare one set of accounts calling consolidated financial statement. So when we are doing this, the statement of financial position, the consolidated statement of financial position, we add P and S, that means parents and subsidiaries, assets together. E asset. Line by line, we asset. Line by line, we add. Line by line, it is added. Then with the consolidation adjustment. Then after adding it, you had to make some consolidation adjustments. What are the consolidation adjustments? Normally, there are 5 workings involved. What is the 5 workings? One, you have to prepare the group structure. What is the percentage of owning? What's the date of acquisition? The group structure, you form one. Then you prepare a net asset schedule for the subsidiary S Limited at the date of acquisition and at the date of reporting. Then the third one, you calculate the goodwill. Fourth one, you calculate the non-controlling interest at the reporting date. Fifth one, you will calculate the group retained earnings as at the reporting date. All these things we will see I will be explaining in another video how we are going to do it practically. Then further adjustments. In addition to this working, there will be further adjustment. One thing you will see, the investment in the separate entity balance sheet of the parent, you will have investment in S. That line disappear. Instead, you will bring in the assets and liabilities. That line disappear. Then only the capital of parent, capital and share premium of parent is included in the consolidated balance sheet or financial position, because only the parent is the owner of all these assets and liabilities. Then you will set off the intercompany trading, because intercompany trading, we see the group has to trade with the outsiders. P&S, parent and subsidiary, are not outsiders. It's one entity. If they are trading in between them, then we have to set off the balances. We will see how we are going to do. Then in setting off, there will be some remaining goods, what have been traded between the subsidiary and parent. That one you will provide a provision for unrealized profit. It is called PERP, and you will adjust it. So all these things have to be done in a consolidation, and we will see in the coming videos how we are going to actually prepare a consolidated statement of financial position and consolidated statement of performance, that is profit or loss. So, okay, if you like this video, please subscribe for it and give your comments in the comments box. And we will see in the next video.